Good afternoon, and welcome to this KBRA webinar titled Credit Unions. Why is it an investable asset class? While all attendees have joined in listen-only mode, we encourage you to engage with our speakers by asking questions through the Q&A feature on your control panel. Additional research regarding credit unions and other topics, as well as our rating reports, can be found on our website at kbra.com. Should you have any additional questions on the topics discussed, we are always available for a follow-up call. Now, I'd like to hand things over to our esteemed speakers for opening remarks.
Thank you, Michelle. Welcome, everybody, to a KBRA webinar. As Michelle mentioned, we're exploring credit unions and their access now to capital markets as they continue to grow in the U.S. Today, I'll be your moderator. I'm Van Hesser, Chief Strategist at KBRA, and I'm joined by four experts very familiar with what's going on with credit unions. Brian Ropp from KBRA, our Senior Credit Analyst covering the sector, Frank Santucci from Stifel Nicolaus, Jacques Disenfal from Piper Sandler, and Daniel Prezioso from Olden Lane. I'll let each of the panelists give a bit more about their background before we get started with our presentation today. Brian, tell us about your role at KBRA.
Thanks, Van. Appreciate the introduction. I'm Brian Ropp. I joined KBRA March of 2020. I'm a managing director, as Van mentioned. Prior to joining the firm, I was CFO of a community bank in Maryland. And before that, I worked on the buy side for 15 years. With that, Van, I'll turn it back to you.
Terrific. Frank, tell us about yourself.
Thank you, Van. Good afternoon, everyone. Frank Santucci. I am a managing director in the strategies team at Stifel Nicolaus and Company, pretty much the head of our credit union practice. Been in this business for a very long time. Just had my 39-year anniversary working with credit unions, and I'll just leave it there. So back to you, Van.
Terrific. Thanks, Frank. Jacques.
Thanks, Van, and thanks very much for hosting this event today. Jacques Disenfal. I run our syndicate and capital markets fixed income practices at Piper Sandler. I've been with Piper Sandler, first with Sandler O'Neill and Partners in 2007, along through the merger with Piper Jaffray, which we are about to hit our 5th anniversary. And like Frank, unfortunately, I just hit my 39th anniversary in the business, so been around a long, long time. Thank you.
Terrific. Thank you for that, Jacques. Daniel.
Thanks, Van. Thanks for having me. I'm a partner at Olden Lane. We're a boutique investment banking practice exclusively dedicated to credit unions. I've been with the firm since its founding around 2016, and I work closely with our subordinated debt issuers.
Terrific. All right, so let's jump in. I'm going to start things off and set the stage with a handful of slides, and then we'll get into the discussion. A lot to talk about this afternoon. So this sector, right, as you all know, not-for-profit, important distinction with our community bank peers, but a not-for-profit business models, tax-exempt institution, a simplified legal structure, no holding companies here to think through, regulated by the National Credit Union Association, the NCUA, tends to reward shareholders above the line, right, with typically higher deposit pricing and lower loan rates. That's the business model and how it compares. You can think about how it compares, again, to the bank model. Collectively, credit unions hold $2.3 trillion in assets, $1.9 trillion in deposits, 71 credit unions greater than $5 billion in assets, and 370 have between $1 and $5 billion. So this is a significant player, obviously, in largely consumer financial services. The largest credit union, Navy Fed, at $177 billion, that would make it a top 25 bank institution. So this is a sector that is certainly has the size and heft to access capital markets. And they are increasingly active in those markets. In 2022, the NCUA authorized issuance of subordinated debt, which does count as regulatory capital. The proceeds of those debt issuances used to fund growth, both organic and through acquisition. 5 deals thus far have been rated, and 75 credit unions have subordinated debt in their capital structure. They also can access term funding through the ABS market, auto finance, an obvious one given the credit union's presence in the auto finance market. Next slide. So, as we mentioned, largely a consumer-focused business model. Things are certainly changing a bit there, but the customer base is consumer-centric. Also can bank commercial entities, and you'll start to see that in certain of the institutions, especially some of the larger, more aggressive strategic institutions out there moving into some commercial lines. The majority of loan composition, however, is 1 to 4 family loans, residential mortgage, and auto, both new and used. A fairly granular loan and deposit base, right? Average loan size just under $20,000, and the average deposit size upwards or up towards $7,000. And as I mentioned, they can originate commercial real estate and C&I loans with certain limitations. But again, this is a largely consumer-focused model that is well entrenched competitively across the sector. Next slide. One of the things I think that's maybe not well understood and worth getting to know as we talk about the creditworthiness of credit unions, a lower history of default compared to banks, right? And we check our chart here. The blue line is the volatility that we know exists in sort of the bank history. Compare that to the gold line there of the total credit union failure rate. So credit unions have a very favorable over a 10-year time horizon, a 50-year time horizon of very, very low failures. And so very attractive from a creditworthiness standpoint, and certainly something that you need to take into consideration when thinking about the risk in this sector. Next slide. A brief introduction or overview of what credit unions have done in the subordinated debt market. As mentioned, in 2022, the NCUA introduced the subordinated debt rule, which expanded the eligibility and implemented a detailed regulatory framework around the issuance of subordinated debt. Now fully mature, we see really expansive growth with 3 9-figure and 5 investment grade rated issuances to date. Also worth mentioning that the Treasury Department it has invested in over $2 billion in subordinated debt of CDFIs and MDI credit unions via the Emergency Capital Investment Program. So again, this sector has become fairly significant in size, and as credit unions continue to grow and more institutions become familiar with this market, we believe it'll continue to grow. Next slide. So before we kick off and start our discussion, here is a list of the 5 credit unions that KBRA has rated, ranging in size from $5 billion up to $15 billion in size. All investment grade rated, and you can see some outlooks there with some variability, 3 negative outlooks out of the 5 ratings that we have, and 2 stable. You can access these reports. We're happy to make these available to you, including a quarterly credit union compendium, along with some specialty reports talking about auto securitizations in the credit union space, our broader ABS sector outlook, talking about some of those sectors that credit unions participate in, especially auto. And then again, we have a sector overview to get you, through the ABCs of looking at the creditworthiness of this sector. So again, relatively new on folks' radar, but one we think worth getting to know. Let me start and kick off the discussion with our own Brian Ropp. Brian, it's been a really interesting time for any financial institution coming through the pandemic period, now coming on the backside of it. bring us up to speed on some of these noteworthy operating trends that that you see on the credit union side. Maybe touch on some of those, what was driving some of the negative outlooks that are, you know, firm specific in some of our ratings.
Yeah, thank you, Van. And that was exactly what I wanted to do. Is so the two most notable trends, I would say, since kind of the onset of the pandemic in 2020 has been net interest margin compression as well as credit performance. And I would say these are not unique to the credit union space. The banking industry has had to deal with both of these issues to some degree as well. So I'm going to kind of just frame, as Van kind of has already painted the picture of a credit union being more consumer oriented. So if you think about the balance sheet construction of a credit union, at least 80% of the average balance sheet is in loans, and that loan breakdown would be about 50% residential mortgages, about 30% of those are fixed rate, the other are variable or adjustable. Then you have about 25% in autos, then another 15% in credit cards and quote other unsecured, and then on average around 8 to 10% of commercial loans. Again, as Van mentioned, that's more of a newer segment of the credit union space. So that's kind of the context of kind of how the balance sheets are constructed. And since the pandemic, the industry's been facing kind of weakened earnings power because of the net interest margin compression. If you look at go back to 2020 when we had the liquidity surge with all of the government stimulus, the large credit unions, and I define large as kind of greater than 5 billion in size, total assets, they outgrew their deposit growth through loan growth in 2021. It was a little more matched in that year, but then when you look at 2022 and 2023, when the Fed started to implement monetary tightening and deposits started kind of leaving the system, the credit union met the borrowing needs and significantly outgrew their deposit growth. So they significantly added assets that were in that kind of lower interest rate environment. And at the time, deposits were kind of leaving. So as you had loans kind of entering the balance sheet and a kind of low rate, the good news is they're fairly short duration loans, so they roll off fairly quickly based on the composition of the loan mix. But the deposit trends also kind of followed what was going on in the bank industry, where you had non-interest bearing deposits migrating to interest bearing. You also had, fewer deposits kind of in the system. So what the credit unions did to plug their funding needs was to tap borrowings, which were kind of market rate. And then they also leaned into time deposits. Again, similar playbook, if you will, that the banking industry followed. But if you look between the first quarter of 2022 and then the fourth quarter of last year, median borrowings for the large credit unions grew from 1% of total funding up to 7%. That has declined going into the 2024 down to 6%. You also have total median time deposits doubling in size from 13% to 27%. So you have 27% of your deposit base now time deposits, so which are again a little closer to market rate, not quite as much as what a borrowing would typically be. So in short, the credit union, which would typically have an asset-sensitive balance sheet, has kind of evolved into more of a liability-sensitive balance sheet. If we think about what that might mean going forward, they are actually the glass half full scenario would be they're well positioned to benefit from the Fed's reduction in interest rates. We did see a troughing of net interest margins at the end of 2023 as the Fed started to pivot to more of away from monetary tightening into maybe the possibility of monetary easing. We did just obviously last week see the benefit of 50 basis points of cuts. We think that will directly benefit the credit unions and their ability to kind of fund the balance sheets at lower rates. And also the growth in time deposits, which I mentioned, are shorter duration, and that will give them the ability to roll them down in lower rates as rates continue to come down. So if I could just recap, you have the ability to kind of reprice down liabilities. So we think overall, I think net interest margin compression should hopefully be behind us, and we'll see some gradual NIM expansion, which will definitely help the earnings profile of the bank. The other, just kind of quickly go through, is the asset quality side. So you have 90% of the loan portfolio geared towards consumer. So even though, consumer typically from a credit quality standpoint is highly correlated to unemployment. As you all know, during this credit cycle or economic cycle, we really didn't see a runoff or a decline in unemployment per se. But what did negatively affect the consumer base for credit unions was inflation. So we see that reflected in delinquency trends, which has definitely been pressured. Credit card delinquencies are elevated kind of up to post-GFC levels. The good news there is it's usually less than 10% of the loan portfolio, but we have seen delinquencies tick up. We've also seen loan delinquencies have ticked up by 20 basis points, median to about 60 basis points. And then first lien mortgages kind of ticked up about 10 basis points to over 20 basis points. With all that said, that's kind of what we see, that's the direction kind of looking forward. But what we've seen from a true loss content standpoint, we have seen some pickup in loss content through net charge-offs from about 40 basis points at 2021 up to about 55 basis points. So, but as we look at the impact from Fed cuts or interest rate cuts to potential net charge-offs going forward, we have seen stabilization of delinquencies and net charge-offs beginning in 2024. We expect that there will be some lagged improvement going forward from the interest rate cuts, and additional interest rate cuts going forward will definitely help the industry. So in conclusion, earnings power has been diminished, but we're cautiously optimistic that the cuts in interest rates will translate into some improvement in credit quality going forward. Although it may be slightly in a lagged effect. So, Van, with that, I will turn it back to you.
Yeah, thank you, Brian. Very comprehensive sort of overview. Frank, let me ask you, you've had a long perspective of covering this sector. You've witnessed some changes here. Bring us up to date on kind of the strategic side of what credit unions are thinking. How prevalent is credit union or our credit unions in thinking about broadening out what they do?
Well, that's a really good question. And before I dive into that, I've got a couple of themes there, but I just did want to echo a couple of things that Brian had to say. That when you think about the credit union space, right, we're talking about basically about community banks that are mutual institutions. They're owned by their depositors, but they're really operating within the same marketplace, right? They have the same issues of interest rate risk and liquidity risk and credit risk and earnings challenges, et cetera. So it really is the same animal here. The difference, to highlight something, Van, that you pointed out, is credit union failure rates have been significantly lower than banks historically. They really have weathered this rising rate environment. When you think about it, had we talked in 2021 or 2022 and someone said, hey, the Fed's going to raise rates 525 basis points in 15 months, most people would have said, you're crazy, right? That's not good. The Fed wasn't even predicting that. During that time, yes, margins tightened just a touch as we got towards the top of the cycle, but actually for the industry as a whole, the last 18 months, margin has stayed within a 6 basis point range. Very, very narrow, very strong performance for the industry in terms of that potential interest rate risk. So I actually think credit unions have outperformed the community bank space as well in the post-COVID world, certainly. In terms of strategic discussions that we're having, really 4 areas in the capital markets area, certainly subordinated debt, talking about that. And again, you highlighted the emergency capital investment program from the U.S. Treasury, COVID relief program authorized by Congress. Roughly half of the credit unions that have subordinated debt got it through ESIP. So you're really dealing with about 85, 86 credit unions that have privately issued subordinated debt historically. I also want to point out that although subordinated debt, by quote unquote, that definition, subordinated debt, was new for credit unions in 2022, they've actually been issuing subordinated debt, they called it secondary capital, since 1995. So this is not new entirely for credit unions. Again, the market has grown substantially. The NCUA has modernized their regulation. But it's also different than the bank space, right? Credit unions have to go through an application process with their regulator. They must get pre-approval from the regulator before they can issue. So that's different than community banks, and I think makes it a little bit more conservative, right? Their plans, their strategies, their process has been vetted, if you will, not approved by, but certainly vetted by the regulator. So the only credit unions that come to market have gone through that regulatory exercise, which is a little bit different than community banks. Second hot topic here is derivatives, right? So in 2018, FASB revised their hedge accounting rules. They introduced last of layer accounting. They updated that again in 2022. And right in the middle of that, the NCUA, the credit union regulator, drafted their derivatives regulation, revised their regulation. So we've seen an explosion of 40% year over year, compounding 40% year over year growth in credit union hedging activity. And certainly, given the volatility of interest rates, easy to understand why. So that's a big topic as well. Actually helps in terms of if you're looking to invest in a credit union, certainly if they're using derivatives to hedge their interest rate risk, that's certainly a benefit. That's a risk reducer for you as an investor. Third thing, you mentioned the asset-backed securities issuance. KBRA had a research report out in May about credit union auto asset-backed securities. There have been 13 asset-backed securities deals to date. That is a very hot topic. We're having conversations all the time about that. That number is growing. Already 4 deals this year, totaling $1.4 billion of auto ABS. Important to note, credit union delinquencies and charge-offs on auto loans significantly below the community bank space. They're really careful with their underwriting. So that's a strength of the industry. So look for that too. And last but not least, the other hot topic is M&A activity. Everybody's talking about mergers and acquisitions. There's a lot of noise, a lot of press, both positive and negative, about credit unions acquiring small community banks. And certainly a lot of consulting work going on in those areas. But I do want to point out, and this isn't in the news because it's not a public deal, but credit union to credit union acquisitions, credit unions acquiring smaller credit unions, infinitely more common, right? There were 194 credit union mergers last year, credit union to credit union. There were only 11 bank acquisitions, right? So the credit union to credit union acquisition space is 20 times, almost 20 times bigger than credit union acquisition of banks. So that consolidation, think again, credit unions are mutual savings banks. They're a form of a just like community banks. So that consolidation in the bank space, you're seeing it in credit unions too. So those are really the 4 hot topics strategically that we're talking to most of our large credit unions about. So
yeah, thanks for that, Frank. That's great color. Dan, let me go to you with a little bit more. If we could dig into the subordinated debt part of the capital stack, or talk about how credit unions are managing their capital with now more options available, as Frank just outlined, to aggressively manage that capital stack. What are you seeing, and what kind of discussions are you having with your clients?
Sure. Well, the credit union sub-debt market in the recent period of emergence that you illustrated has really been driven by growth and growth opportunities. Of course, credit unions' sources of capital traditionally are limited to their retained earnings. So to the extent that they grow at a pace that exceeds the amount of their return on equity, the result is going to be capital dilution. Subordinated debt's a tool that credit unions can use to supplement their capital during those periods and offset any capital dilution. So traditionally, where a credit union sees organic growth opportunities or is growing organically faster than they have historically, they would consider subordinated debt. Of course, M&A related growth has always been a use case for subordinated debt, and as that deal activity has picked up, so has the interest in subordinated debt. And some have used it strategically to sort of fortify the balance sheet, anticipating maybe a turn in the business cycle where you might get higher savings rate at the same time as credit losses elevate, creating sort of a dual pressure on capital that subordinated debt could be used to help offset. And we saw a confluence of these factors really come together during the pandemic, and it really drove a lot of growth There's some numbers on this chart in terms of new issuance, excluding the issuance to the Department of Treasury in respect of that public program, ESIP. This is just issuance to private investors. And you can see, during the pandemic, in that 12-month period from the middle of 2021 to 2022, we really saw a dramatic increase in new issuance, almost threefold relative to the 12-month period before it. That was also a period where we saw some record-breaking pace of deal activity with respect to M&A. Of course, during the pandemic, like most depository institutions, credit unions were inundated with deposits. I think the average growth rate peaked at 20% in Q1 of 2021. So that drove a lot of interest in subordinated debt to kind of restore capital ratios to where they had been prior to the pandemic, and anticipate perhaps a difficult recovery from the pandemic, and allow credit unions to really keep a high level of engagement with their members during a period of time when they felt that their members needed them most. Since then, during the monetary tightening cycle, we've seen the growth in new issuance slow considerably, as you can see on this chart. And that's pretty obvious as to some of the reasons why. Organic growth is a lot more expensive. Deposits now a lot more difficult to come by. Of course, as Brian was mentioning, the cost of liabilities increased rather quickly, which did put pressure on margins. So subordinated debt, being one of the more expensive liabilities, became less attractive. But we still see higher or equivalent rates of new issuance as we did in that period before the height of the pandemic. So there's still a similar mix of use cases. It's just that the growth has slowed. Of course, we're seeing deal activity start to rage this year. If you look at the announcements with respect to bank acquisitions, only a handful of them have utilized subordinated debt. More than half of those are actually issued to the Treasury. But I can tell you anecdotally, based on our pipeline, it's definitely a use case that about half of our issuers are interested in. So it's going to be a driver. I think as rates come down, we're going to see some of the issuers that have been on the sideline, and there's a number of them, consider the market a little more closely. As Frank was mentioning, any issuance has to get regulatory approval, and we track that process through Freedom of Information Act requests. In 2022, there was over 1.2 billion of volume of new issuance approved for issuance to private investors. And as you can see, we certainly haven't filled that amount. And last year, there was about 540 million approved. Now that 2022 vintage, that over $1 billion of approval, that's due to expire. That is expiring this year. So it'll be interesting in the fourth quarter to see if we don't see a flurry of activity. But in our experience right now, we're seeing a lot of those issuers allow those approvals to lapse. And then next year, there's a pretty substantial amount of dry powder right now from last year's approvals, in addition to those that are being built up this year. So it'd be interesting, potential for some interesting dynamics in the market if conditions do shift quickly and issuers start to go to market. There's plenty of them that could glut the market potentially in a short period of time.
Yeah, thank you for that, Dan. Let's go over to Jacques to talk about sort of the market receptivity towards the credit union story. Obviously, Jacques, you're very active in the bank capital market for community banks. Talk about credit unions access. What's similar in terms of what investors are looking for? What are some of the differences or different feedback you get from investors? What's the market telling you about credit union access to the debt market?
Yeah, thanks, Van. And we got involved in the credit union space in 2022, and our first transaction was the large ViStar deal, of course. And as you said, we've had a very big business in the regional and community bank sub-debt business going all the way back to 2014. And we've obviously worked very closely with you guys at Kroll for many years on rating a lot of our clients. So we definitely have modeled our credit union distribution very closely to the way we developed our regional and community bank sub-debt business. As Frank and the other guys have said, there's just a lot of similarities into the two markets. Obviously, the regulatory bodies are different. There's more restrictions around the credit union universe, and that issuers can't be buyers and buyers can't be issuers. So there's a little bit more of a restricted airspace that we can kind of navigate and go out and educate. You don't have the the large template of thousands of banks that would be eligible buyers. So it has been very important to diversify the distribution, especially in the larger deals that we've been involved in, ViStar, the Global, the Idaho Central. So we had very good success with the insurance companies. In those three deals, we had a very good presence and penetration from some of our insurance companies that have been buying the community and regional bank sub-debt over the years. We tried to go after our community banks, seeing that our coverage nationwide is so strong. We have had limited but solid success, but clearly the presence and the strength of the credit unions themselves in the deals have been awfully strong, which is mirrored and been exactly what we saw when we were developing the sub-debt market for regional and community banks. Unfortunately, we've gone through the volatile market, the 11 interest rate hikes, and obviously last year, even the Kroll sub-debt market, as we talked about on the community bank podcast a couple of months ago, was completely shut. In the credit union space, at least we got the Global and the Idaho deals done in 2023. So I think things look very, very good from a distribution and placement perspective. We've reopened the Kroll regional and subordinated bank debt market this year. We've already done 6 deals for almost $700 million. So we are quite confident the credit unions will be following suit. We have several applications that have been approved and several in process. And I think one of the very important facets is that there's been such a stark rally in the large cap Moody's and S&P corporate bond market. The average IG coupon is now down around 4.5. We started the year at 6. You've got credit spreads down at a 2.5-year low. You've got the high yield index that has recently broken through 7%. Double Bs have broken through 6%. So the regional and community bank debt deals that we've been completing have been coming in at 8 to 9% range. The credit unions are obviously going to be aligned with those types of coupons. So the relative value that's out there right now for the space is going to be exceedingly attractive, not only to CUs and banks and insurance companies, but like we've seen in our recent deals, we have been seeing an avalanche of buyers and interested parties come in, and many guys just have not even looked at the space in over 2 years, given the environment that we've been through. We're in the market right now with a deal. We've had over 150 investors sign the NDA looking at the deal. So that relative value perspective is very important. Obviously, we've just had the first 50 basis point cut with more on the way. We've had a tremendous run on interest rates. We're down over 100 basis points since late April. So, the markets are very inviting right now. So, we're quite excited with the credit union calendar that's going to come upon us. And Van, I think the distribution platform is going to be extremely strong across each basket of investors for it when the calendar starts in earnest again.
Yeah, I think that's right, Jacques. We talked about it on my podcast this past week, the relative value. It really is how public deals have ripped in the last several weeks or so. It does push investors out looking for yield into structured product, into privates, into off-index sectors like community banks and credit unions. And Frank, I'll ask you essentially the same question, but part of why I think the appeal is here is the soft landing that seems to be a broad consensus now. The Fed doing what I think investors believe is the right thing. It's not often you can pull off a 50 basis point cut and not have it be done for an alarming reason, but I think Jay Powell has done a reasonable job of it. But Frank, tell us or give us some perspective on what are investors telling you about the credit union space, how they compare it to community banks. Obviously, the low default history is a terrific selling point, but what else is how comfortable are investors now going back into the depository sector like credit unions?
Well, look, I think post SVB and Signature Bank, right? The market certainly froze for an extended period of time, a good 12, 15 months. There were some credit union deals done. Again, Jacques mentioned the Global and the Idaho deal that was done right after Silicon Valley Bank, and then the market really quieted down. I would tell you behind the scenes, there were a lot of smaller private placement deals that weren't rated, they weren't public, they weren't CUSIP, that got done behind the scenes as the graphic showed, a good 15 deals done in the trailing 12 months. The bank market has just now started to reopen. As Jacques said, they've gotten some deals done. I know KBW has gotten some deals done. And I think in terms of the future of the credit union space, credit unions are lagging the bank sub-debt market by 8 to 10 years, right? So if you think of where the bank sub-debt market was in 2012, 13, 14, that's where the credit union market is today in terms of acceptance and knowledge and investor awareness. So it is still, it's still a bit of, I don't want to say a struggle, but there's some work to be done there in terms of educating folks about the capital structure of credit unions and what they are and what their regulatory environment is, et cetera. But I think in terms of issuance, right, if we compare bank issuance between 2019 and the failure of SVB, there's roughly 10 billion in community bank sub-debt issuance in that 4-year window. In the last 4 years, credit unions have seen outside of ESIP about 1.5 billion of issuance of subordinated debt. So it's just a fraction, it's about a tenth, which when you think about it logically makes sense. The banking industry is 23 trillion in size. Credit unions are 2.3, about 1/10 of the size. So credit unions are on a growth trajectory, very similar to the community bank space, just lagging by about 10 years. So I think the sky is the limit here. I think we should see, to Daniel's point, there is a lot of pent-up application. He mentioned you get the application approved by the NCUA, then you can go issue. You only have 2 years. After 2 years, that application expires. And when we say application, this is a process. It's a good 4, 5, 6 month process of developing a strategic plan, submitting that to your regulator, having it vetted by them, having to stress test that, answer their questions. This is not just a fill out the form and send an email, give me approval. It doesn't work that way. It's hard. It's very hard to get approved. There was a point in time where NCUA was denying 70 to 80% of the applications they got because they were concerned. They wanted to make sure credit unions knew what they were doing before they came to market. They were very worried about the reputation risk there. So that has changed. The credit union sophistication level has changed. I think the ability of actual capital markets bankers like us, the three that you have here getting involved in the space, has helped. We have experience in the bank sub-debt space, so that makes it, we just translate that over to the credit union space. But I think over the next 15, 18, 24 months, we are going to see an explosion in credit union deals coming to market. I think demand is certainly going to be there. I think from an investor perspective, for banks that invest in credit unions, so this is something, again, unique, to issue subordinated debt and have it count as Tier 1 equity, the credit union must be low income designated. That's a Census Bureau designation based upon their field of membership, who their customers are. If you buy the sub-debt, if you're a bank and you buy the sub-debt of a credit union, regardless of geography, you get CRA credit for that investment. And it is specifically in the CRA regulation. It says if you invest in the capital of a low-income designated credit union, regardless of geography, you get CRA credit. So there is going to be demand there, I think, given the renewed focus on CRA in the bank space, for banks to be looking to buy credit union sub-debt. So that's going to help in terms of driving demand going forward as well.
Yeah. All right, Brian, it sounds like you've got to clear your desk. You've got a a fair amount of pipeline coming your way. But Brian, quickly, I want to make sure we leave lots of time here for questions because we've got quite a few. But talk to us a little bit about how your rating committees treat a community bank versus a credit union. Are they essentially the same, or what are some of those key differences that you think investors should really pick up on in the credit union sector?
So Van, thank you for that question. And so, yeah, I mean, this could be a fairly short conversation. The way we approach rating for credit unions is we actually apply our bank rating methodology. So we're using the same methodology that we apply on banks. So view a lot of similarities between banks and credit unions. As I think Frank mentioned earlier, it's essentially a credit union is very similar, if not almost identical to a mutual bank kind of business model where it's more of a quote cooperative. So we feel like there's a lot of parallels between the bank rating methodology and how we're thinking about credit unions. So we apply the same methodology that's available publicly on our website, kbra.com. I'll just kind of very quickly summarize kind of the key ratings approaches. So there's a quantitative and a qualitative nature. So for quantitative, we look at earnings performance, asset quality, capital, funding, and liquidity. Each of those are weighted 25%. Qualitative, we look at market strategy, risk management, liquidity management, and operating environment. And again, those are all weighted 25%. Since the credit unions are more of a simplified business model or capital structure, they don't have holding companies. So we rate them kind of like we would rate a bank that doesn't have a holding company, which we do have a handful of those. So you don't have the issues with structural subordination between the operating company and the holding company. And then we also consider external factors like legislative and regulatory. But I would just kind of stress, so we're going to rate a credit union under the same kind of scrutiny and that we would a bank, and we don't really kind of differentiate that. So we hold them up to the same standards as a bank and look at all those kind of key components, and they work off of a similar rating scale. So,
yeah, perfect. Jacques, let me go back to you and let's talk about the environment a little bit. Tricky windows between now and the end of the year. That's true in every year, but this one, we also have a very consequential presidential election staring at us here. So we got the Fed cutting rates, we got the presidential election. Broadly speaking, how are you thinking about the rates and political environment affecting investor demand, we think ultimately for bank or credit union subordinated debt?
Yeah, thanks, Van. No, I think we're in a very good space. As I mentioned, we've had a tremendous run on rates down over 100 across the curve since end of April. Obviously got the first cut under our belts. Most of the market, of course, was expecting 25. We got the 50. We've kind of been treading water here on rates since Wednesday's cut, but I think Chairman Powell tempered the cut by saying this isn't direct signs of what's to come, although we've had a lot of good positive Fed speak here over the last couple of days. But no, clearly with the transactions that we're bringing to market, we are seeing dramatically stronger rosters in looking at the deals. We've never had this many people looking at our deals lately. As I said before, we're seeing investors that have not been in the market in the last 2 years return. We're seeing bigger, more everyday corporate bond, sophisticated guys saying they'd never buy a community bank or a credit union deal ever again. We're seeing a lot of those guys back looking at deals and buying our deals. So it's good. For us FIG guys, as we know, it's been a rough run over the last year and a half, especially 2023. So the calendar's building up nicely. Investors obviously see the relative value that I spoke about, given the compression and the coupons declining the way they are in the large cap market. So yeah, I'm quite bullish. We're obviously got a couple more cuts in store here. Interesting. I really, from my seat on the syndicate desk, the election, the election stuff and all the stuff we love watching on TV every night does not seem to be affecting the market whatsoever. I think investors are looking at maybe this might be the last opportunity, the last stretch where they can get some real relative value out there. That's why the risk taking is increasing the way it is. I mean, the greatest sign that I love to look at recently is the triple C sector in the high yield market. We started the year at over 14%. That triple C index is all the way down at 10.5. So it just shows you that people are out there taking risk again. You see the volumes in the high yield market, and obviously with the more infrequent issuer and newer companies that come to market that we specialize in. It's been a flight to quality, so it's been great to see buyers return to the market. So yes, from my perspective, very constructive market into year end. We got to keep our eye on the geopolitical risk, obviously with Israel and Hezbollah. The market doesn't seem to be blinking an eye at that. So there's certainly some things that could cause some volatility. But from a macro standpoint, knock on wood, we're in a good position, and the markets are heading even to better places.
Yeah, let's hope that all continues. Dan, let me go back to you, and as with any regulated entity, the regulator is an important credit consideration here. What should we know about the NCUA? How do you compare them to the bank regulators? Is there anything going on that front that investors really need to be aware of?
Well, there's certainly heightened supervision over the past year and a half since Silicon Valley and Signature Bank. I think the NCUA just announced that as of Q2, credit unions with a CAMEL rating of 3 or less is up 150% relative to the end of 2022, and that's been continuing to grow. Of course, for subordinated debt issuers who have a rather rigorous regulatory process to overcome to get to market, that's definitely a factor. Scrutiny on applications are up. Frank is correct that in previous years we've seen the approval rate on applications going in very much the right direction. The NCUA was very active in codifying its rules and regulations in the period between 2020 and 2022, even put a whole new rule regime in relative to it. And during that period, we saw application approvals really start to climb to a peak of about over 80% being approved in 2022. But last year that dropped to closer to 70. So it's a process for issuers that has gotten a little more difficult over the past 6 quarters. It probably will be for a little while longer until examiners are happy with what they see and some of the pressures on profitability have been relieved. There's also some significant personnel changes at the NCUA that anyone considering being an issuer should think about. Anyone in this market should be paying attention to. The NCUA is separated into 3 different regions, the East, the South, and the West. Each of those regions makes the determination in respect of each application, depending on where the issuer is. So it's a regional determination controlled by the director of each of those regions. Historically, there's been a lot of variability among the utilization of subordinated debt in each of those regions, with the East being a region that utilizes subordinated debt at a small fraction of the rate of the other 2 regions. There's probably multiple factors for that, but one of them is definitely regulatory environment. The South has always been the most productive in terms of sub-debt issuance, with the West kind of closely behind them. The regional director in the West, Sherry Freed, who had been a regional director through the entire emergence of subordinated debt, retired in August. The regional director in the East, I understand, is filling that role on an interim basis, with an active regional director being elevated in the East now. So that could be a significant change. It's hard to say how that'll play out and what that will mean, but we'll certainly be watching it for any relevant consequence, and we'll be helping our clients adapt to it. And then Tom Fay, who is a capital markets specialist at the NCUA, who had a personal role in all of the NCUA's policies with respect to capital markets over the years, and it's been quite an active period. He also retired in March. So some of the expertise that had been guiding the agency through the recent period is no longer there. So we got to watch carefully to see what changes now that some of the personnel is going to be, and the leadership on these issues is going to be quite a bit different going forward.
Okay, terrific color, good insight. All right, I think that's it for our prepared remarks. Michelle or Caitlin, do you want to kick off our Q&A?
Absolutely. Yes, so our first question from the audience is, do you think the asset size and limited geographic diversification of most credit unions is a hindrance to their credit profile? Why or why not?
Brian, you want to talk about that? Is there a size bias or a geographic bias in terms of how you think about creditworthiness of credit unions?
So I don't know if I would say a total size bias. What I would say is if you have a credit union that is primarily focused on one particular economic center, say maybe one city, one smaller area, that would definitely come into play by how we would kind of evaluate the creditworthiness of that credit union. But the other thing I would say is, a lot of credit unions have indirect auto programs, and they can extend, out of county they can cross state lines. So even though, so a credit union of reasonable size will typically have a fairly diverse loan portfolio, which is one of the things that we're going to take a look at. If you think about the olden days where you had kind of the corporate town and everything was centered around that company, that would be a business model we would probably be a little more concerned about. But I don't think that really is an issue per se. But we would want some geographic diversification as far as economic output to kind of what's going to drive the loan performance of the credit union. So I don't know if I'd say a particular bias, but we're going to definitely drill down into that loan portfolio and really understand what the underlying economic drivers are and make sure there is some diversification there.
Okay, got it. Here's a question from the audience, and I'll make it a jump ball here. While the failures are lower than the banks, please talk about the consequences of a failure in terms of potential recovery for credit union sub-debt holders versus the same for a bank holding company holder, given that there are no shareholders, quote unquote, among credit unions. How do we think about, or how should investors think about recovery value in the unlikely case of a credit union failure? Anybody want to take that one?
Well, I'll make a comment here first of all, and then the other folks can jump in as well. But I think that in the credit union space, subordinated debt is a misnomer because there is no senior debt, right? So the credit union that issues debt that's counted as capital, it is their senior debt, in fact. So, and I would tell you that it is being a mutual institution, right? So for a credit union to get to the point of failure, we would have to see losses, loan losses, credit losses generally, that wipe out their earnings, that then wipe out their allowance for loan loss. And credit unions are very well reserved. They've got $1.50 in reserve for every dollar of delinquency. They're over reserved, quite frankly, and that number is growing under CECL, by the way, giving you even more protection. Then it has to erode their retained earnings. Credit union average credit union net worth to asset tier 1 leverage ratio is 11%. So we've got to wipe out that earnings. Along the way, the regulator has to turn a blind eye, not step in and say, hey, what are you doing? Let's correct this problem. Let that credit union get all the way to the point of wiping out all their retained earnings before that sub debt ever gets touched. Highly, highly, highly unlikely. In my analysis, I went back and looked at every issuer of they called it secondary capital, the old grandfathered subordinated debt. In history, since 1995, there was one failure ever. It was a tiny credit union that had gotten, like ESIP money, they had gotten TARP money from the U.S. Treasury. And this credit union was no more than 2 million in size. They had a couple of 100,000. And by the way, NCUA paid the Treasury back. So no one in the history of credit unions has ever lost a penny on credit union issued subordinated debt. So from that standpoint, I think it's, again, there's no guarantees here, right? It is unsecured debt to the credit union, but it's certainly the safety, the history of safety is certainly there. So.
Yeah, I think that covers it pretty well. Thank you, Frank. Another question came in from the audience. Be interested to understand what kind of term funding options are available to credit unions. I assume this would be secured, unsecured. Dan, do you want to take a crack at that one? What are the funding options available for credit unions today, the term funding options?
They're big FHLB borrowers. They typically have a line with their corporate credit union, sort of their banker's bank system. Occasionally, there's a line with a commercial bank, but the FHLB is the primary lender, secured lender to credit unions, with the corporate credit union system, sort of a supplemental line of credit. Very little unsecured borrowing other than subordinated debt. They can issue non-member deposits to other depository institutions and to public entities. Most of the industry, a little more than half, has a low-income designation that allows them to issue deposits, brokered CDs to anyone. So most have the ability to, unfettered ability to tap the brokered time deposit market as well.
Okay. I know, Frank, you talked about a little bit the asset-backed options that are also now becoming available. And you mentioned quite a few of your in your coverage universe are thinking about those options.
Yeah. Well, you have that. You've also got a lot of credit. Most credit unions also now belong to the Fed Reserve or members of the Fed. Credit unions had a big chunk of bank term funding that they took out, just like community banks. They had that same arbitrage opportunity. Credit unions took advantage of that as well. Some of the larger credit unions took out a big chunk of that, like the community banks did. In fact, I think credit unions were a little bit more accepting of that. They didn't have the same reputation risk that a lot of community banks expressed to us anyway. They said, boy, I don't want to do that. I got burned on TARP. The regulator came back at me a couple of years later about that, so I don't want to touch this bank term funding. Credit unions didn't have that same issue. And in addition to the asset-backed securities market, there's about $1 to $1.5 billion of loan participations traded among credit unions as well. So similar to the ABS market, but again, not securitized, not rated. But that market never shuts down. It runs nonstop, $1.5 billion a month, quite frankly, in loan participation. So the funding options, credit union liquidity, sources of liquidity are extraordinary. They're cash cows. They really are. Not an issue for credit unions at all.
Yeah. And one last question here, which maybe I'll steer towards you, Jacques. For investors that choose not to participate, whether it's a community bank deal or a credit union deal, give me 2 or 3 reasons why people are not participating or have not participated maybe in the recent past, but might be open now, given that everything we've talked about, soft landing, better rate environment. Talk to us about some of the reasons, some of the pushback against, or you see against investing in the sector.
You know, great question, Van. And, you know, I think, as Frank mentioned, you know, the market I would call it's still in its infancy, especially now being rated by Kroll. So a lot of investors wanted to watch the first issuances and see how they performed. Obviously, the market environment worsened with all the rate hikes, and then of course the bank failures. And of course, we had a couple of outlook negatives put on a couple of the larger issuers. So there was certainly a segment of the market that wanted to just kind of wait and watch, see more issues come, see more secondary trading, that sort of thing. I think what's been the most eye-opening aspect and fact is that when you look at the sector historically versus the banking sector, the defaults are much lower. And I think a lot of investors were skeptical about that. And thus we're seeing the questions come in here now from that. So there's definitely a number of investors that wanted more concrete information and more convincing over the credit qualityness of the credit unions. And then, as you brought up before, certainly there's a lot of investors out there, especially when we've been in this flight to quality mentality over the last couple of years. The size of the institution has certainly been very, very important. Thus, the larger issuances, you know, we saw really strong investor interest in and some good diversity there. But again, given where we are in the interest rate period right now, the upcoming cuts, I think we're going to see a lot of new investors come into the space as the calendar rebuilds and we see more issuances. And like I said, I think the market's still in its infancy, and there's going to be a lot of progress made in investor penetration as we move forward.
All right, so I think with that, we'll let that be the last word. Thank you all for attending and listening today. I want to thank my panelists, Brian Ropp from KBRA, Frank Santucci from Stifel Nicolaus, Jacques Sanfal from Piper Sandler, and Daniel Prezioso from Olden Lane. Terrific insight, and for what sounds like a sector that's going to be increasingly active and worth getting on your radar. Thanks again for attending.